You have $200, not $200 saved, $200 total. That is what is left, after rent, after groceries, after the phone bill you almost missed last month. You heard someone mention the stock market at work. You downloaded an app. You stared at it for 3 days, without putting anything in. You are afraid of losing the $200. You are more afraid of staying exactly where you are. You put in $50. You buy one share of something you recognize, a company whose product you use every day. It feels ridiculous. One share, $50. You watch it move up $0.43 and feel something you cannot explain. This is how it starts. Not with knowledge. With curiosity that costs $50. You are putting in $50 every month now. You do not tell anyone. It feels too small to mention, too embarrassing to explain. Your friends are buying things you can see. Clothes, nights out, weekend trips. You are buying something invisible that does nothing for months. The market drops 8% in 2 weeks. Your $500 becomes $460. You feel sick. You check it 17 times in 1 day. You do not sell. Not because you are disciplined, because you are too scared to lock in the loss. That fear accidentally saves you. The market recovers. Your $460 becomes $530. You did nothing. The doing nothing was the right move. The first rule: the market will test you before it rewards you. Most people fail the test. You passed it by accident. Pass it on purpose next time. You start reading. Not tips. Not predictions. Not which stock is going to explode next month. You read about how markets actually work. Compound interest. Index funds. Time in the market versus timing the market. You move most of your money into a total market index fund. It feels boring. It is supposed to feel boring. Boring is the strategy. You open a Roth IRA. You contribute $100 a month. The tax advantages feel abstract right now. In 30 years, they will feel like a gift you gave yourself. You watch someone at work make $4,000 in 2 weeks on a meme stock. You feel the pull. You stay in your index fund. They lose it all 3 weeks later. You stay in your index fund. You cross 5 figures for the first time. You check the balance 3 times in 1 day. Not from anxiety, from disbelief. $10,000 feels like a different category of person. You are not a different person, but you feel it. Your money returned $340 last year without you touching it. That is not a lot of money. That is proof of concept. That is the machine taking its first breath. You increase your monthly contribution to $200. You stop buying things you do not need without thinking about it first. Not because you are cheap, because you have started to see every dollar differently. Every dollar is either a soldier or a surrender. You are 27. Your portfolio has gone through 2 real corrections now. One was 12%, one was 19%. Both felt like the world was ending. Both recovered. You did not sell either time. You understand something now that you could not have read in a book. Volatility is not the enemy. Panic is the enemy. The market does not destroy wealth. People destroy their own wealth by responding to the market emotionally. You start maxing your 401k. You do not feel it in your paycheck as much as you expected. Your net worth crosses $40,000. You built that. Not your employer, not luck. You. The second rule: the market does not care about your feelings. The sooner you stop having feelings about it, the sooner it starts working for you. Something shifts. Your portfolio returned $6,200 last year. You did not work for that $6,200. You did not trade your time for it. It arrived because you stayed. You start thinking about money differently, not as something you earn, as something you build systems to generate. You open a brokerage account separate from your retirement accounts. You keep 80% in index funds. You allocate 20% to individual companies you have researched deeply. You lose money on 2 of them. You make significantly more on 1 of them. You are learning the difference between investing and gambling. The difference is research, patience, and position sizing. Most people never learn this. They call it luck in both directions. You are 31. Your portfolio generates roughly $12,000 a year in paper returns. Some years more, some years less. You have never timed the market correctly. Nobody does consistently. You stopped trying 2 years ago. You start thinking about the number that means something real. The number where your investments could theoretically replace your income. For you, that number is somewhere around $1.2 million at a 5% return. That number used to feel impossible. Now it feels like math. You increase your contributions again. You decline a lease on a new car. You drive what you have. The car does not compound. The investment does. The third rule: lifestyle inflation is the silent tax on wealth. Every upgrade you make to your life before you hit your number is a delay in reaching your number. You are 34. Your portfolio has a personality now. It has preferences. Certain positions feel right. Others feel like noise. You have been invested through a bear market, a real one. 34% down, over 14 months. You watched $100,000 of paper wealth disappear. You did not sell. You bought more on the way down. When it recovered, you had more shares than you started with. You understand now what the wealthy have always known. Bear markets are not disasters. They are sales. Most people cannot see that when they are inside one. Your annual return on investment last year was $24,000. That is more than many people earn in a year. You earned it by owning pieces of companies that kept operating while you slept. The fourth rule: below $500,000 you are building the machine. Above it, the machine starts building itself. Your returns last year were $41,000. That is more than your first salary, generated by capital you built over a decade. Capital that does not need a vacation day, does not call in sick, does not ask for a raise. You stop thinking about your portfolio in terms of what it is worth today. You start thinking about what it generates annually. The shift from accumulation thinking to income thinking is the shift that separates investors from wealthy people. You have friends who earn more than you, some of them significantly more. None of them have what you have, not because they could not, because they did not start, because they spent the years you were investing on things that are already gone. A Tuesday, no ceremony, no notification, just a number on a screen that ends in 6 figures. You thought you would feel different. You sit with it for a moment. There is a quiet satisfaction. Then, almost immediately, you think about what comes next. $1 million at a 4% return is $40,000 a year. That is not retirement. That is a starting point. The milestone was never the destination. It was the proof that the strategy works, the proof that patience works, the proof that you were right to stay when everyone around you was either panicking or gambling. You keep going. Money stops being a source of anxiety. For the first time in your adult life, it is simply a resource, like time, like energy. You think about where it is positioned, not whether you have enough. Your portfolio generates $180,000 a year in average returns. You do not spend $180,000 a year. The gap between what you generate and what you spend is compounding on top of itself. You have reached the level where wealth creation becomes self-sustaining. You are no longer pushing the boulder up the hill. The boulder is rolling. Your job now is to not stand in its way. The 5th rule. The goal was never to get rich. The goal was to build something that removes the financial ceiling from your life entirely. At this level, you have done that. What you do with the ceiling gone is the question nobody prepares you for. You are 44. You do not check your portfolio every day. Sometimes you go a week without looking. You have been wrong about the market many times. You have lost more money in single corrections than most people earn in years. It does not alter your strategy. It informs it. You have started teaching your children what nobody taught you. Not just how to invest, how to think about money, how to delay, how to be patient in a world designed to make patience feel like weakness. You give more than you used to, not for recognition, because at this level, money has stopped being a measure of your worth, and giving is one of the remaining things that still feels like a decision. You are 51. Your portfolio generates enough annually that working is optional. You still work, but differently, on things you choose, at a pace you set. You think about the 22-year-old you were, staring at an app, $50, one share of a company whose coffee you drank every morning. You think about every moment you almost sold, every correction that felt like the end, every time someone told you the market was too risky, or too high, or too broken to trust. You stayed anyway. The machine ran anyway. And somewhere right now there is a 22-year-old opening an investment app for the first time. Balance, $200. One share of something they recognize. Watching it move $0.43. Feeling something they cannot explain. That feeling is the beginning of everything. The 6th rule. The best time to start was the day you first thought about it. The second best time is right now. The market does not wait for you to feel ready. Neither should you. Drop a comment below and tell me where you are right now on this journey. $0, $10,000, $100,000. Wherever you are not behind. You are exactly where consistent action from today will take you further than you think. If this video showed you something real, hit that like button right now. Subscribe to Mr. Wealthy for more real finance stories that nobody else is telling. See you in the next one.